Silver has delivered one of the most explosive moves in recent precious metals history. We're not talking about a gentle uptrend. We're talking about a market that ripped through $90, experienced intraday swings of 15%, and is now setting its sights on a level that seemed impossible just months ago, $106 per ounce. If you've been watching silver, you've felt the intensity. Sharp rallies, followed by stomach-dropping corrections that shake out weak hands, only to recover and push higher again. But there's more happening beneath the surface. Rumors are circulating about massive short positions held by major banks, and the physical market is showing signs of stress. Today, we're going to break down the complete picture, the technical roadmap to $106, what's happening in the physical versus paper markets, and what happens after that critical target is reached. The technical framework. Let's start with the technical roadmap. Silver's current move can be measured using Fibonacci extension tools. These levels matter because enough traders watch them, making them self-fulfilling prophecies when markets get emotional. Silver made a powerful surge, peaked, then pulled back into a clear low. When we measure that impulse move and project forward, two key zones emerge. The first is the 61.8% extension, the golden ratio. Silver already tested this zone around $90 to $93. We saw sharp drops that looked like the rally was over, but buyers stepped back in aggressively. That recovery is significant. It shows the market is testing conviction rather than showing weakness. The second level is the 100% measured move extension at approximately $106. This represents roughly a 16% move from recent levels. In normal markets, that's substantial. In silver, with current volatility, that can happen in days. The paper versus physical disconnect now, here's where it gets interesting. There's a viral narrative circulating about Bank of America and Citi allegedly being short 4.4 billion ounces of silver combined. That would be more than 5 times annual global production, which sits around 800 million ounces per year. Now let's be clear, there is no verified data from regulators like the CFTC confirming this specific claim. Total open interest in COMEX silver futures for all participants is closer to 1 billion ounces, not 4.4 billion for just 2 banks. These viral numbers appear to be exaggerated or fabricated based on unverified social media posts. However, the narrative highlights something real: tension between paper and physical markets. Industrial demand already consumes about 60% of annual silver output for electronics, solar panels, medicine, and other applications. The investment-grade free float available for delivery is relatively small. When futures markets are large relative to available physical supply, and when price moves this fast, stress appears. Physical premiums can spike, delivery delays can occur, and volatility amplifies as leveraged positions get forced out. Whether or not the specific bank short position numbers are accurate, the underlying dynamic is real. This market is structurally tight, and that tightness contributes to the explosive price action we're seeing. Understanding the volatility, here's what's driving these violent swings. As silver prices climb, exchanges raise margin requirements to protect the system and reduce risk. The practical effect is brutal for leveraged traders. Positions that were profitable suddenly get margin calls. Traders are forced to sell. That selling creates those ugly sudden drops that make everyone think the rally is finished. But if underlying momentum remains intact, new buyers step in at lower levels, and the rally continues. We've seen sessions where the range from high to low exceeded 15%. That's not a calm bull market. That's a market that can build wealth or destroy accounts in the same day. This is why risk management isn't optional. It's survival. The combination of thin physical supply, large paper market positioning, and margin-driven forced liquidations creates the perfect storm for extreme volatility. The psychology of $106 is more than just a technical level. It's an emotional trigger. Think about the trader who sold at $90 feeling smart. They locked in profits and felt disciplined. Then silver hits 97. A little uncomfortable, but they tell themselves it'll pull back. Then 102. Now they're annoyed. They start second-guessing their decision. Then it tags 106. At this point, logic disappears. They're not thinking about risk-reward anymore. They're thinking, I have to get back in. I'm missing the move. That is classic FOMO behavior. When FOMO shows up near major technical targets, it often marks a turning point, not always a crash, but a moment that matters. Sometimes it's a pause, a long, frustrating consolidation that chops sideways and punishes impatient traders who chase. Understanding this psychology helps you avoid becoming part of the herd that buys the top. 2 scenarios. After 106, so what happens if silver reaches $106? There are 2 main paths forward. Scenario 1, consolidation before continuation. Silver tags the target, cools off, builds a base in a sideways range, and then later pushes toward 120, 125, or higher. In this scenario, 106 isn't the end. It's an intermission where the market digests gains before the next leg. This is the healthier pattern for sustained bull markets. Scenario 2, topping behavior. Silver reaches 106, forms a distribution pattern where smart money exits into public enthusiasm, and then begins a significant correction. This isn't bearish on silver long term. It's just how parabolic moves work. They don't gently pull back 10% and continue higher. They often collapse violently. History shows us this pattern clearly. In 1980 and again in 2011, silver experienced massive spikes followed by corrections of 50 to 70% from peak levels. If silver hits 106 and corrects by that same magnitude, we'd be looking at potential pullbacks to the $30 to $50 range. That's not fear-mongering or trying to scare you. That's historical precedent. Every cycle is different and conditions change, but ignoring history because this time is different is one of the most expensive mistakes traders make. Risk management reality. Here's the uncomfortable truth that most analysis channels avoid saying out loud: nobody knows the future. Not me, not the biggest banks, not the loudest voices on social media claiming massive short squeezes are guaranteed. What we can do is follow price action, volume patterns, and manage risk accordingly. Taking profits incrementally during strength allows you to participate in the rally while protecting capital. Rebalancing when silver becomes too large, a portion of your portfolio isn't bearish. It's intelligent portfolio management. The rumors about massive bank short positions add an interesting narrative, but they shouldn't be the basis of your investment decisions when the numbers aren't verified. What matters is how price behaves at key levels, how volume responds, and whether momentum can sustain itself. Hope is not a strategy. Having a clear plan for different outcomes with defined exit points for both profit-taking and stop losses separates traders who survive these moves from those who give back all their gains. Closing silver has already delivered extraordinary returns, rising over 200% from year-ago levels. Whether 106 gets reached depends on sustained momentum and continued buying pressure. The physical market dynamics and paper market positioning add fuel to this fire, but they also add risk. What matters more than hitting any specific number is having a clear plan and managing risk appropriately. The market will show us its hand through price action at these key levels. We'll see if buyers can push through resistance or if profit-taking intensifies. Stay disciplined, stay objective, and remember that the best trades are the ones where you survive to trade another day. Silver's volatility creates opportunity, but it also demands respect.